Welcome to Three Simple Things, a Gennari Aronson series of tips and information from our corporate and transactional practice. Today, we'll talk about purchase price. Buyers and sellers in transactions consider two essential questions. What's the purchase price, and under what circumstances might the purchase price have to be paid back? The best purchase price is one that's paid up front at a closing, all in cash. That doesn't always happen, and sellers should know the alternatives and some of the jargon. Let's talk today about earnouts, rollover equity, and holdbacks. Earnouts. An earnout is a purchase price in which some element of the consideration must be earned. It's contingent on the acquired company meeting specific performance goals, like revenue, profit, or customer targets, after the deal closes. We tell sellers to count on only what they get up front at the closing. Anything else is upside. Indeed, if a seller would only do the transaction if the full earnout is paid, they'll best be served by waiting for another deal. Earnouts are complicated, expensive for both sides, and involve risks for buyers too. If buyers offer an earnout, they also must cede some basic post-closing control to allow the seller to achieve the milestones. Both sides should consider the risks and the rewards of an earnout before they pay lawyers to start the drafting process. Transactions with earnouts always take longer and cost more in legal and accounting fees. Rollover equity. Obviously, sellers should pay close attention to any non-cash portion of a purchase price. Many financial or private equity buyers will offer equity in the continuing company to sellers, allowing them in theory to roll over sales proceeds into the continuing business. Sellers should consider the business and tax implications of rollover equity and review the relevant equity investment documents as if they were an angel investor, because in this case, they are. The equity documents themselves also contain obligations, non-competes, non-disclosures, and sometimes capital call requirements applicable to all equity holders. Sellers should know what they're signing up for. Holdbacks. In addition to rollover equity, some buyers will ask sellers to take some portion of the purchase price later, often on the first or second anniversary of the closing. Sellers should view these holdback payments for what they are, an extension of unsecured credit to the buyer. Sellers must remember the higher purchase price is appealing, but only if it's actually paid. We often help sellers sort through the various mechanisms they might put in place to secure payment. If you're considering a sale of your business, we strongly recommend that you consult with your legal and accounting advisors in connection with evaluating and negotiating an M&A transaction.